Hello, it's Valuable Tips here. Welcome to my channel. Please like, share and subscribe. Only you can show support. These are the criteria that truly allow one to outperform the market after additional research by a third-party investor. These are taken from the Benjamin Graham last study that he made before he passed. 1, 2, 6, 7 of the criteria are important and gives the highest outperformance. Firstly, earnings to price yield of at least twice the AAA bond rate, which is the government bond rate. Secondly, price to earnings ratio less than 40% of the highest price to earnings ratio the stock had over the past 5 years. This is hard to achieve as it requires the stock price to crash 40% and you manage to buy at the moment when it crashed, or the earnings to spike up by around 1.67 times, so an increase of 67%. Thus for me, I like it to be just 15% or lower than the highest price to earnings ratio instead. Thirdly, total debt must be less than book value, which implies that they should not borrow more than the equity they have. This makes sense, and also I would like to look at the cost of debt, which is the interest in percentage form of the debt. Fourthly, current ratio must be greater than 2. This implies that the current assets to current liability ratio is around 2:1, resulting in least chance of cash flow issue in case a crisis happens. Next, for growth, I usually look at operating cash flow, revenue, earnings per share to see if it's a rising trend. An easy and mathematical way to do this is to take the last 3-year average and see if it's larger than the middle 4 years average, and that middle 4-year average is larger than the first 3-year average in a 10 years data range. This also coincides with what Benjamin Graham said in his book Intelligent Investor. Also, I look at quarterly report and annual report once in a blue moon to check for whether they are taking new loans at a higher rate, and if the new loan is sustainable, like is it lower than the average dividends payout of other investment at around 4 to 5%. I do read other part of the report just to educate myself on how the management is like for the qualitative analysis side, but this is not a must, and I have only done it for like 3 to 4 companies that I was invested in. There's a secret trick to looking at annual or quarterly report. Since you already know the years where certain crises occur, such as 2008, 2000, 1980, 2020, 2016, you can look at the reports of the company that you are researching on up till that point in time to see how they prepare and react to the crisis. Thank you for staying with me till the end. I really appreciate it.